Hey, good afternoon, everyone. It's Terry Gardner from CJ Lawrence. It's Wednesday, the 16th of November, coming to you from the CJ Lawrence Global Headquarters here in Midtown Manhattan. We've got some market commentary for you today and 4 quick points that we'd like to cover. The first being we want to take a look at third quarter earnings and see how they've come in versus expectations. Secondly, we want to take a look at some of the information that we look at and discuss at our investment committee meetings that we hold here at CJ Lawrence. And then third, we want to talk about the broken seesaw that we experienced in the third quarter with regard to prices of asset classes. And then finally look at kind of a year-end checklist of some things that we should be staying on top of as we start to reach into the end of 2022. So first off, with regard to earnings, about 92% of the companies in the S&P 500 have now reported. 70% of those have posted a positive surprise. On average, over the last couple of decades, that number is closer to 80%, so a little bit below past averages. Nonetheless, the majority of companies that are reporting better than expected forecasts. Growth for the quarter is coming in at about 2.2%. So, and that's come down over the last several months. So that's something to keep an eye on. Growth expectations now for the fourth quarter for earnings are down 2%. So we're starting to really see some erosion in earnings forecasts for this quarter, next quarter, and into the first quarter of 2023, which is expected to grow only 1.7%. Earnings now for the full year 2023 are expected to grow 5.8%. At the beginning of the year, that estimate was closer to 10%. So clearly a ratcheting down of expectations as to where earnings are going to go in the coming quarters and the coming year. And we need earnings to grow in this environment where we have higher interest rates, which compresses the PE multiple on stocks. It's really incumbent on earnings to grow to move stock prices higher. So number two, we want to talk about what I mentioned earlier is the seesaw in asset prices that we saw, and asset price performance that we saw in the third quarter. So we just talked about earnings, now we want to talk about prices. And the broken seesaw is how we describe what happened between stocks and bonds in the quarter. Usually, over history, one offsets the other. When you have strong stock price performance, you often have weaker bond performance and vice versa. When bonds are strong, stocks tend to not fare as well. But in the third quarter of this year, the seesaw broke. Both sides were down. In fact, and I outlined this in our quarterly letter to clients. If you're interested, I'm happy to share it with you. But a couple of numbers that I cited were the S&P 500 declined 5.2% in the quarter. Meanwhile, if you look at the Morningstar 10-plus year Treasury bond index, that fell by more than 10%. Why is it meaningful? It rarely happens. In fact, it happens less than 10% of the time in the quarters measured all the way back to 1926. So it was really a remarkable quarter from that perspective. Now, we've seen the seesaw get some repair in the fourth quarter. Stocks are up nicely, bonds are up, but not as much, so there's a differential there. The S&P 500 quarter to date is up 11.5%. So it's obviously coming off a bottom and some weakness in the third quarter. Meanwhile, the short-term bond index is up 92 basis points. The long-term bond index on a total return basis is up 75 basis points. So with that all as backdrop, and with a meaningful rebound in stock prices here already in the fourth quarter, and with the earnings outlook, as we suggested earlier, being somewhat tepid, it's tough to make a very bullish case for the indexes to advance broadly in the coming year, but you can clearly make a case for certain stocks, bullish case for certain stocks to perform well. And that's kind of where we're really staying focused. We are becoming increasingly selective and really focused on those companies that can grow earnings despite the macro backdrop. So where do we find those outperformers? I mentioned in the introduction how I would share a little bit of work from our investment committee meeting. We meet every Wednesday here at CJ Lawrence, discuss the stocks in our portfolios, our stock bond mixes, and we look each week at a table that was created by the C.J. Lawrence Inc., the old C.J. Lawrence back in the 1980s by our chairman, Jim Maltz, and updated ever since then, called Sector Shifts. And it just essentially tracks the weighting of the different sectors within the S&P 500 index. And it's interesting to look at how these sectors grow in their influence or wane in their influence over time. And so what we've highlighted, certainly, and it's been well reported, the rollover in the technology weighting within the index, which peaked at around 29%, is now down to 26.5%. That's quite interesting. At the same time, energy has found its legs again. Energy, as a percentage of the 500, troughed in 2020 at about 2.3%. Now is about 5.4%. So we like to look at these long-term sector shifts, sector changes within the index. If you can catch a wave, either up or down, sometimes that the influence in the index can change over a long period of time, and you can find really interesting opportunities within those sectors that are gaining in weighting within the index. The one that we have been highlighting a little bit is industrials, which now stands at about 8.5% of the index. Probably troughed in 2021 at 7.7. It's down from 2010, it was 11%. So the point being that, hey, that's kind of a fertile area to look for some interesting new ideas, some names that might be benefiting from new secular changes in the economy. And we've highlighted a couple of themes within the sector that we're watching quite closely and investing against, including defense, advanced manufacturing, robotics, reshoring, supply chain repair and reconstruction. Those are all themes that are evolving and changing within the industrial sector, and within those themes are some really interesting new opportunities, which we've been investing in over the last 6 months and plan to continue to do so. So that's certainly an area, despite index challenges, where there's individual sector and stock opportunities. So finally, it's getting close to year end. From a planning perspective, it is important to dust off those checklists, make sure that everything's kind of squared away going into year end. We do a lot of that here at CJ Lawrence. We're very engaged now in tax loss harvesting as we get closer to the end of the year. It's an important time to be focused also on any charitable contributions that you want to make at year end here, in addition to contributions to retirement plans, considering Roth conversions, Roth IRA conversions, contributions to health savings accounts, 529 plans, including 529 ABLE plans. So we're discussing a lot of these issues and activities with our clients. All should be thought about at year end. There's obviously some leeway in some of these areas up until tax time in April, but we think it's good to stay as close to a calendar year process as possible. So if you'd like to discuss these or any other investments in your portfolio, feel free to give us a ring here. My number is 212-888-6403, or you can email me at tgardner@cjlawrence.com. Thanks, and have a great rest of your week.